relatively small, but nevertheless not insignificant. Subprime auto, sort of retailer slash lender, American Car Center, went out of business, and it happened really quickly.
Just tying this to the nowcast, what's interesting now is that this should happen faster, right? Because the cost of capital, particularly short-term capital, has gone essentially vertical, right? I mean, the 2-year yield this morning is at like 285, or sorry, at 485. So you have the most inverted that the curve's been since we went bearish. An inversion, of course, would perpetuate our bearishness. And new cycle lows in 10s, 2s this morning, minus 88, I think it is, on 10s, minus 2s. Obviously, that should mean that we're peak bearishness heading into the first of 2 negative GDP quarters on the headline. Just the nominal, when consumption coming out of holiday, because these are January numbers, nominal is nominal. When you're paying for things you need, it doesn't mean that consumption is ripping. It just means that the prices you're paying are ripping, So, but then net, we take that January number. It's almost like the Federal Reserve they are reading yesterday's news, right? Like Powell literally in his most recent press conference said, I get up in the morning and I read the papers. Okay. So he's reading January numbers. We're about to enter March, by next week. And all that does sequentially is it sets up the personal consumption and income numbers to go down sequentially. So the likelihood is that what it did, the Atlanta Fed number went up. They have very few data points right now. So they're at like 275 now, I think. And so now it's going to go from an even higher point of expectations and hawkishness. It's fully loaded, right? If the Fed sees good data looking backwards, just like inflation, they thought it was going to stay low looking backwards. And currently real GDP, our nowcasts are to surprise on growth what they were to inflation when they called it transitory. So anyway, that's just kind of a recap on why our numbers moved a little bit, but why they'll only fall further now versus expectations. And I just wanted to get your comment or thoughts on that nominal nature of consumption growth.
A lot of the influence on the January numbers has been this sort of, this confluence of 3 factors. One is the sort of SS COLA kick in, right? So the Social Security COLA bump went into effect Jan 1. So that contributed, sort of a significant sort of short-term step up. 2 was the lapping.
How many, Steiner? How many Americans got that? Like, do you know how many Americans have COLA as a cost of living adjustment? COLA.
Yeah, I got to double check my numbers here, but I looked into this recently. I think it's between 40 and 60 million.
Right. So, it's 0 people on Wall Street. We know that. That's why they don't get it. But it's around. It's something. Yeah. Okay. Anyway, so that's point number 1.
Second point is, and we've heard this on a number of fronts, and just anecdotally, it's true. You had an unseasonably warm January, and so that brings out sort of patterns of behavior and spending that are atypical for that time of year. And then thirdly, you're lapping the Omicron, relatively easier Omicron January 2022 comps. So you put those 3 things together, and that's really what's sort of driven this January lift.
Hey there, Hedgeye Nation, or if you're not part of Hedgeye Nation, thanks for watching Hedgeye on YouTube. If you haven't already, make sure to click on the button below there. Subscribe to our YouTube page. You can also follow the link in the description to our website to get even more great investing content.